Hey, today we'll give you 5 simple steps to start investing today for beginners. Investing can seem intimidating, especially for beginners. With so many options, terms, and strategies, it's easy to feel overwhelmed. However, starting early, even with small amounts, can set you on the path to financial independence and long-term wealth. Here are 5 simple steps to help you begin your investment journey today. Step 1. Educate yourself. Before diving into the world of investing, take time to understand the basics. Knowledge is your greatest asset when it comes to making informed decisions. Learn key concepts. Familiarize yourself with terms like stocks, bonds, mutual funds, ETFs, exchange-traded funds, dividends, compound interest, and risk tolerance. Understand risk versus reward. All investments carry some level of risk. Generally, higher risk investments have the potential for higher returns, while lower risk options offer stability but slower growth. Use free resources. Websites like Investopedia, YouTube channels, blogs, and podcasts provide beginner-friendly explanations of investment concepts. Pro tip: start small and focus on one concept at a time. You don't need to be an expert overnight. Step 2. Set clear financial goals. Having clear goals will guide your investment strategy and keep you motivated. Short-term goals: saving for a vacation, buying a car, or building an emergency fund. Long-term goals: retirement planning, purchasing a home, or funding your child's education. SMART goals: make sure your goals are specific, measurable, achievable, relevant, and time-bound. For example, I want to save $10,000 in 5 years by investing $150 per month. By defining your objectives, you'll know whether to prioritize high-growth investments or safer, steady income options. Step 3. Start small and build consistently. You don't need thousands of dollars to start investing. Many platforms allow you to begin with as little as $10 or even spare change. Micro-investing apps, platforms like Acorns or Stash, let you invest small amounts regularly, rounding up purchases to the nearest dollar and investing the difference. Dollar cost averaging, DCA. Instead of trying to time the market, invest a fixed amount at regular intervals, e.g., monthly. This reduces the impact of market volatility. Automate contributions. Set up automatic transfers to your investment account to ensure consistency without having to think about it. Remember, the power of compounding works best over time, so starting early, even with small contributions, is key. Step 4. Choose the right investment vehicles. There are several ways to invest depending on your goals, risk tolerance, and timeline. Here are some beginner-friendly options. Stocks. Buying shares of individual companies gives you ownership in those businesses. While potentially lucrative, stocks can be volatile. ETFs and index funds. These track a basket of assets, like the S&P 500, and offer diversification at a low cost. They're ideal for beginners who want broad market exposure. Bonds. Government or corporate bonds provide stable, predictable income, but typically yield lower returns than stocks. Robo-advisors. Services like Betterment or Wealthfront create and manage a diversified portfolio for you based on your goals and risk tolerance. Real estate crowdfunding. Platforms like Fundrise allow you to invest in real estate projects with minimal capital. For most beginners, starting with low-cost index funds or ETFs is a smart choice due to their simplicity and strong historical performance. Step 5. Stay patient and avoid emotional decisions. The stock market can be unpredictable, with ups and downs that may tempt you to make impulsive decisions. Here's how to stay disciplined. Think long-term. Markets tend to rise over time despite short-term fluctuations. Focus on your goals rather than daily price changes. Avoid timing the market. Trying to predict when to buy or sell often leads to missed opportunities. Stick to your plan. Review regularly. Check your portfolio periodically, e.g., quarterly or annually, to ensure it aligns with your goals, but avoid constant monitoring. Ignore noise. Tune out sensational headlines and social media hype. Trust your research and strategy. Patience is one of the most important traits of successful investors. Remember, slow and steady wins the race. Final thoughts. Starting to invest doesn't have to be complicated or overwhelming. By educating yourself, setting clear goals, starting small, choosing the right vehicles, and staying patient, you can build wealth gradually and confidently. The earlier you begin, the more time your money has to grow through the magic of compounding. Take action today, even if it's just opening an account or committing to learn more. Your future self will thank you. If you like the video, hit the subscribe button and follow us for more content.